Today's discussion revolves around recent revelations exposing synthetic shares and questionable financial practices. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But everyone, remember, this is not a financial advice video. A key development is the announcement of an independent audit into the SEC, a move that could unearth serious issues within the organization. This audit follows numerous instances where regulatory bodies imposed fines on major firms while allowing them to continue profiting on a massive scale. The question arises, what impact do these fines really have when they amount to mere fractions of a company's earnings? $1 million fine means little to a corporation generating billions in annual profits. This situation underscores the need for transparency and accountability, which this audit aims to address. Elon Musk, having previously clashed with short sellers targeting Tesla, is now supporting an investigation that could benefit retail investors. Short sellers have long manipulated financial markets, leveraging their influence to suppress stock prices and profit from declining values. The exposure of these actors could be a game changer, revealing the extent of synthetic shares and manipulated trading practices. A viral meme highlights the reality of the situation. A massive part of the financial system is entangled in these practices. This aligns with past collapses, such as those involving Archegos Capital and Credit Suisse, both of which were linked to toxic short positions. The sheer scale of synthetic shares and swaps remains largely unknown, but the audit could force these figures into the public eye. Tweets from financial analysts and retail investors alike demand that regulators disclose the true share count of stocks like AMC. If retail investors supposedly own 80% of available shares, how do we explain the existence of hundreds of millions of failed-to-deliver FTD shares? This contradiction suggests that the actual number of issued shares is far greater than officially reported, raising suspicions of fraudulent activity. Calls for the SEC to obtain a verified AMC share count from brokers are gaining traction, as the reported 380 million share float appears inconsistent with the number of shares being traded. Further complicating matters, reports indicate that firms have used cryptocurrency to artificially locate shares, circumventing traditional financial controls. This creative manipulation of the market makes it crucial for investigators to determine the full extent of synthetic shares and illegal trading practices. By uncovering these details, retail investors will finally gain clarity on how market manipulation affects their holdings. The significance of synthetic shares cannot be overstated. An estimate suggests that if 358,000 investors each held 500 AMC shares, it would be enough to reveal massive discrepancies in share counts. Yet, institutions have avoided releasing this data, fearing that transparency would expose their fraudulent strategies. Another pressing concern is the confidential agreements between major trading firms. Why would Citadel and FTX engage in undisclosed settlements? What is the nature of Virtu's credit agreements with FTX? These opaque deals suggest an effort to conceal damaging financial information. In past cases, FTX claimed to hold 400 million AMC tokens backed 1-to-1, but this assertion was later proven false. If leading market participants engage in such deceptive practices, it raises questions about the broader financial landscape. This secrecy extends beyond firms to regulatory measures themselves. Delays in reporting short positions, efforts to dismantle transparency mechanisms, and institutional reluctance to disclose data all point to a system designed to obscure the truth. The push to halt the CAT system and postpone short position disclosures for a year further illustrates this resistance to oversight. The upcoming audit represents a significant step toward breaking this cycle of concealment. If conducted properly, it could expose the full scope of synthetic trading and lead to meaningful reforms. Another layer to this issue is the role of brokers in the lending of retail shares. Many investors unknowingly have their shares lent out through securities lending programs, which benefit brokers at their expense. For instance, some programs allow brokers to retain 85% of the lending fees while passing only 15% to investors. This arrangement directly contributes to stock price suppression, as lent shares are often used by short sellers to push prices lower. Investors who support retail-driven movements like those in AMC and GME should be aware of how their shares are being used against them. Compounding this issue, some clearing firms have engaged in stock lending without informing investors or providing adequate compensation. Apex Clearing Corp, for example, has been implicated in lending shares to short sellers without the account holder's knowledge. This practice affects investors' tax obligations, dividend payments, and overall portfolio performance. These are yet more reasons why the true share count remains a critical point of concern. Institutions and brokers actively work to keep share counts hidden because revealing them could collapse the entire synthetic share structure. If just one brokerage were to confirm that 358,000 investors each hold 500 shares, the implications would be staggering. This fear drives institutions to maintain confidential agreements, delay transparency initiatives, and manipulate market structures to their advantage. The refusal to disclose data is not accidental. It is a calculated effort to maintain control over the financial system. Recent filings reveal that some broker-dealers report large short positions, indicating that their exposure is significant. Smaller brokers, like those involved in past market disruptions, hold millions in shorted securities. Robinhood, for instance, faced liquidity issues due to the sheer volume of synthetic shares tied to AMC and GME. These concerns explain why brokers push to lend shares without full disclosure. Doing so provides them with the liquidity they need to cover their own short positions. This entire situation underscores the immense costs involved in maintaining short positions. From financing positions and creating synthetic shares to running trading algorithms and meeting margin requirements, these operations are expensive. Institutions engage in lending schemes and hidden financial deals as a means of managing these costs. Their ability to sustain these strategies depends on keeping the truth from being fully revealed. As the audit progresses, the financial community watches closely. If conducted thoroughly, this investigation could finally provide retail investors with the transparency they deserve. The exposure of synthetic shares, hidden agreements, and systemic manipulation has the potential to shake the financial world to its core. Retail investors should remain vigilant, continue demanding accountability, and push for reforms that ensure fair and transparent markets. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.